Welcome to TradeTheMBI.com. This is John. This report is for the 2nd of May. Well, we're going to start the month, and you can see the year to date. That's where the market is from the start of the year. And what we're looking at is just a continuation of the weakness. Again, every time we've hit key resistance zones, in this particular case, right around 4,300, so 38% is at 4,298. Keeps getting rejected off of that point. And what we've noticed is the rising MBI weight. Even though magenta was still enough with the support over yellow, any pivot under that 25, not to mention just having white under 25, but now that it's reset with yellow underneath the 10 level, you have the potential for bounces within this configuration. Of course, with the white leading, the expectation is a move towards 0%. But that was a significant blowout the other day, minus 146. So that, we've had some of these other 100-plus point moves back forth within days. This sort of pushes that envelope, and that what you get is those extended deviations. And when they start to move past the expected ranges, and of course, even those broader ranges were getting up there. Now you start to push that envelope a little bit, and you begin to terrify some people. Below 4,000, I think that you'll see a lot of panic. So there's going to be an intense amount of desire to maintain that 4,100 level, because you can see last time we supported right off of that before, we had that long wick that took us down to the 4093, which is the 0%. But that really is one of those factors that starts to weigh on the psychology. And of course, we talked about the psychology anyway. From a Fed's desire, this kind of volatility scares people, moves them into treasuries. They really need that in order to abate the rise in rates. And as I was talking about earlier at the beginning of the year, as well as for the last couple of months, is that given everyone's expectation that interest rates are going to rise and that home buying should have reached a fever pitch, knowing full well exactly what was going to happen, and that's not what's taken place. And I also mentioned before too that the precipitous nature, they always forget this when it comes to economics, is that when a movement starts towards weakness, it accelerates at an exponential factor that they often don't project, which is why everyone was so shocked at a negative GDP reading that came in for the quarter. Hardly a surprise. Everyone front-loaded seeing inflation at the end of last year, bought up a lot of inventories. Of course, that's what they're going to blame it on. But as prices rise, fine, you get earnings increases and things like that, but what you don't get is more widgets sold. And this is what we're starting to see from the earnings report. And I said that this would become an accelerated factor that they really weren't taking into account, but that once it was realized, it would have a material effect on the market. And this is exactly what we have. Now, you have a lot of subsequent things. Russia's continuing to move forward with its transition towards a ruble based in gold and commodities, and that is going to wreak havoc on non-base currencies, meaning buying the US dollar will do well, but the yen, the euro, some of these peripheral currencies are just going to be hammered off that because they don't have any reason to be bought. And particularly the euro. So the flight of capital from the euro is going to be significant. Not to mention the euro keeps shooting itself in the foot with the ECB and their sanctions towards Russia, and it's creating enormous problems from their energy sector, which is going to cause huge recession in Europe. I mean, you can already see it with the prices of everything skyrocketing, and then the devaluation of its currency. It becomes a snowball effect. That's literally where the term comes from, and worth noting. The 0% has already been reached from a NASDAQ standpoint. We're actually made those new lows before, and we're right back at it, and looks worse from an MBI reading. From a DOC, you've got the reset and the potential for a turnaround, as well as from a shakeout standpoint. So we're seeing the lower lows on higher extreme readings and that. So and after this kind of a route, I mean, a move of 75 points higher or whatever would still be in line with that kind of dip recovery. It wouldn't necessarily mean that the worst is over. It's just you're going to get a lot of those rips when it becomes, evident from at least a fund standpoint and stuff where they think that they can average in to what are already some losing positions for the year in that and help to mitigate it. But, on the 5th or so, we're around the 4th, through the 6th, we're going to see new fund money comes in, and we're going to see where that goes, because as interest rates rise, treasuries become much more attractive, or even secondary issues, because they can at least give a yield enough to moderately lose to inflation, but at least not suffer the capital risk that the market has created, because you're looking at companies and their valuations being exponentially higher than normal. Now, that's not surprising given the inflation. So you have to understand that the market is always going to inflate to cover that monetary loss. But you get a real problem when you get into a stagflation situation, and that becomes a whole secondary item, and whether or not the market believes that's going to take place. There's still a whole lot of people that still believe the U.S. economy is strong, vibrant, and that this was a fluke for the quarter. Of course, by the time you get the second quarter, it's going to be too late. The market will have already figured that out, and I can guarantee you they're combing that data. So we're going to see it in our readings primarily, and it'll show from the negative standpoint of the MBI as well as a DOC, where we start to roll back over. The euro has like bounced back off of that. They're really going to support around that 105, and you can see it was interesting because we ended up with the euro pumping, and then there was these systematic end of day skyrockets for the market that have been taking place over the last couple of weeks. And it clearly looks like intervention. I mean, you can say it's from algo or whatever, but they're quite significant and able to move the market in significant ways. So interesting that regular traders would wait that long is unlikely. So it's just a bizarre kind of thing that you have to pay attention to, which is why I always say when the readings flip, you just have to go with that and not hold to a narrative, because that will get you in a lot of trouble. But the euro, a pivot back up of the orange. I would expect it to come back, but it's possible that we'll see a little bit of a rally here trying to support to see if they can get some momentum. But things really don't look attractive from that viewpoint. Gold has been depressed quite a bit, but of course in market selling, a lot of times you have to liquidate those positions in order to cover other setups. Of course, we're seeing the orange dip here, so that technically puts it into a buy configuration. You just need to see the magenta rise above white there. We could get another nice run. Oil continues to remain well above that 100, and again, this just puts pressure on the economy. Of course, this is all self-inflicted. There was no reason for any of it, but they have to deal with it. And of course, despite the fact that you've had those capital flows, again, rates continue to rise. 119 now, we expect that to break again, looking more towards that 115 for TLT, which is an indication that rates are continuing to rise. If the Fed believes that the economy is still relatively, I think that the negative GDP numbers probably eliminated the idea of a 3/4 basis point move. So the 50 basis points, more likely than not, but some may believe that they may even cut that to a quarter, which it would be insignificant. It would have zero impact whatsoever. And some of these things are beyond the Fed's ability to raise rates to moderate the inflation, because the inflation is related to world events as well as coming crisis. We have, the food situation hasn't even really caught enough attention yet. It will in another couple months as they start to look at the global situation. It may not be as big an impact in the U.S., but certainly overall prices are going to rise simply because the products in that it takes to produce food. And people forget that natural gas is used in the creation of fertilizers. There's already a huge reduction in fertilizer with the Russia's sanctions. So there's just a lot of problems. Bitcoin has been trading pretty much in tandem with the NASDAQ at this particular stage. We can almost put the daily chart of the NASDAQ right over that, and it looks almost identical to it. Below that 39, problematic. Now it's held pretty close around there, but the next range below would be the 34. So there's quite a bit of empty space in between here. Obviously, this previous bounce level of 37 would be the next spot that I would look at flipping towards a buy configuration, though you haven't had a full reset of the orange in this particular case. So, without a breach of that 23%, I think it's probably going to be under more pressure. From a 50K standpoint, what you're looking at from this would be an adjustment to the NBI pink bar. The dark red, it doesn't have any other significance than what we were measuring is the NBI yellow below 25. And that's what you'll see, because we find that weakness occurs dramatically and pretty much stays there until you get a move of the magenta back over orange. But again, when it then pivots back below, assuming that it's getting over white as well. And so that's where I'm going to be making the adjustments to, unfortunately, family issues, and then unfortunately my lovely dog Mobiloni died just yesterday, and that's kind of held back a little bit of the progress, but certainly we'll be getting them out shortly as we move forward under these things. But clearly the short was just brilliant from that configuration on the 50K, and completely just no support whatsoever. This would be the futures algo strategy, which is equivalent to the Power Mode 2 Opus 2T. Just change the name to make it simpler. It's just a futures algorithm. So simplifying some of those things is to make it easier for you. When we flip to the 50K, 5K, I can actually put up the alternative 5K. This is the one that represents the new programming set up within it. Really, there wasn't a whole lot of change between the current one and the new version, simply because it was mostly all down all day. There really wasn't anything to change. We started up here at the resistance level was 4265 with the algo previous that we had, and then we had the 4236, which supported for quite a while, and then it became apparent once we got to the actual cash open that there was a recognition in some players' minds that things were not all rosy, and we started to fade softly, but then it really started picking up steam. This was a pretty good range for just the 20 minutes, but then the volume really started to pick up as some of the sell programs activated, and we just ended up with a whole lot of red. We did get some nice little buy turnarounds, but every time they hit that 50% magenta would fade below, and that just led to some just beautiful runs. So it was pretty easy to just keep adding any pop. There weren't a whole lot of them, but when they did pop up in place, it was like, okay, let me look for my magenta pivot. Boom, as soon as it came in, attack that. And then towards later in the day, we started to see that extreme of the DOC red when it gets well below that 25. Usually you get some kind of bounce back, usually after P2. So the first one and then the secondary P2 took place right there, pretty much at the lows. Still wouldn't be attractive until we started to see the shakeout moving above that negative 13, and it started to catch a little bit of support there towards the end of the day, which nominally not unexpected given some short covering, but still barely got it to the 50%, and still looking at weakness. I would expect potentially for a weak open, unless again the traders think that they've got broadly one side trapped. But in this particular case, it's going to be a little tougher. The question will be whether or not the week begins with a series of margin calls and things like that for some, and that would be really interesting because that is the kind of event. So I would expect the plunge protection team to be active in trying to support things because that kind of margin call thing would create a hemorrhage effect and really send things into a spiral, in which case we would not be holding 41, let alone 4,000. So keep that one in mind. As always, though, indicators will be going out for May. Trade well. We'll talk again later.